Hey, if you're looking to acquire a small business, one of the most complicated aspects of that whole acquisition process is something called net working capital and how to calculate what net working capital should be. And then also this process after the acquisition called a true-up process. I'm going to walk through all of this. It's a little bit confusing, but it is an important thing for you as a buyer or a seller to really understand, just to make sure that you know what you're getting yourself into and what you're agreeing to. A lot of times this can get kind of fought between the lawyers and the CPAs involved in the process, but in this video what I want to do is try to explain it in such a way that you as either the buyer of the business or the seller of the business can understand what the CPAs and the attorneys are talking about in this process. So first of all, what is net working capital and why does it matter in a small business acquisition? Well, the idea of net working capital or having working capital in general as part of the acquisition is that the buyer often wants the seller to leave them with enough working capital to be able to continue to operate the business without interruption. Okay, so you buy the business today and it turns out that, in 2 days it's time for payroll. Well, did the seller leave you enough cash in the account or enough working capital to meet payroll in 2 days? These are things that as a buyer you may not think about. You may be just thinking about, I got to come up with the cash to acquire the business, and it's a profitable business and it cash flows, and so I'm not really too worried about the working capital. Well, if you think about that though, that scenario of you buy the business on the 13th of the month and the 15th is the day when you have to pay payroll for the last couple of weeks. Well, did you have enough cash to make sure you could meet that, right? So that's just a quick example of why having working capital is important in an acquisition. And so the common way to kind of think about how you calculate how much working capital should be left in the business is this kind of current assets minus current liabilities. And so I've got a spreadsheet pulled up here with some examples. So some examples of current assets are your accounts receivable, your inventory, your prepaid expenses, and your other current assets, all taken from the balance sheet. And then current liabilities are things like accounts payable, which is just the bills that you owe vendors or other businesses. And then accrued expenses, accrued payroll, accrued taxes, deferred revenue, and other current liabilities are all different kinds of liabilities that go into that total current liability calculation. So in order to see at a high level how much net working capital you should have, you're really just taking the difference between total current assets minus total current liabilities. So when we do that right now, what we get here is $33,000. So we're saying the estimated net working capital is $33,000. This business has net working capital of $33,000, right? So once the acquisition actually happens, so the challenge here is determining whether these numbers are exactly perfect as of the moment of the acquisition, right? So think about this. You've got a manufacturing business and the business is running on the day of the acquisition, right? You want it to keep running. You don't want them to just stop work. So the business is operating, and the morning you sign the papers at noon, right? Well, they calculated maybe the night before or maybe a few days ago. They did a accounts receivable count. They did an inventory count. They estimated what their prepaid expenses were, right? They gave you all of these numbers to calculate that net working capital number. But then in between the time of them calculating that and then you signing the dotted line to buy the business, things change, right? The business is continuing to operate. And so maybe they made a big inventory purchase the day before because that was just part of their normal operations. They needed to purchase inventory. Or maybe they ended up getting a big check that came in from their accounts receivable. So accounts receivable is actually lower and that cash had already come in, and maybe you had negotiated with the seller that they were going to get to take the cash in the checking account, right? And so they got that check in that morning. What happens with that check? If a customer paid him $40,000 the morning of the acquisition, what happens to that? Because you were counting on that to come in through this accounts receivable number, right? So these are the type of things that it's impossible to know exactly what these numbers are going to be at the exact point of the acquisition and what the cutoff is going to be, right? And you can also kind of do some squirrely things with it too if you're not really precise about this. And so this is important to have your lawyer and probably CPA really make sure they help you with this process. Make sure they know what the calculation should be and what the cutoff should be, and that it's written out well, so that neither party there's no dispute, right? But kind of no matter what, there's going to be some change to what was estimated as the working capital numbers for all of these numbers and what it actually ended up being. Because just like I said, maybe they sold a bunch of inventory the morning of, or they made a big inventory purchase the morning of, right? And so you end up with some adjustment. And so what typically happens, maybe it's 60 days, 90 days after the acquisition closes, you go through a process of calculating what is the adjusted numbers, what was it actually? So this is what we thought it was going to be, but it turned out this is what it actually ended up being, right? And so sometimes there's going to be a difference. And so we have some examples here of there could be differences. So maybe there was an increase in accounts receivable, there's a decrease in inventory, there was an increase in accounts payable. So what would that mean if there's an increase in accounts payable? That means maybe they placed an order for something, the seller and the current company placed an order for something the morning of the acquisition for $2,000. It wasn't listed in their accounts payable at the time of the sale. And you end up getting a bill 3 days later and you're like, hey, I never paid for I never ordered this. And it turns out it was the seller right before the seller that made that order, right? So that would be an example of, okay, we got this bill that came in after the acquisition date. It wasn't included in the accounts payable at the time. And so we need to add that. And in that scenario, the seller is going to owe the buyer $2,000 for that, right? There was extra accounts payable that they did not disclose. And so the buyer's going to have to go ahead and pay the bills, right? Buyer's I got to pay my vendors. During that true up calculation, after 60 or 90 days, the buyer should get reimbursed from the seller for that extra accounts payable. So those are some examples of why there might be a true up and why it would be different. It's almost certainly going to be different. And it could be a very material amount as well, depending on the size and scope of your business. So this is an annoying part of the acquisition, but an important part. And so I encourage you to make sure you have good legal counsel that's really knows what they're doing on this, and a CPA that's going to help you represent you, whether you're the buyer or the seller, just making sure that you are on the same page there. And one other thing that I would mention is that there's an expectation that there's going to be either the buyer's going to owe the seller or the seller's going to owe the buyer. There's probably going to be some change. And so it's not out of the ordinary for part of the deal to be that both the buyer and the seller put some money aside in escrow. Okay. And so at the time of closing, maybe each party puts in $50,000 into escrow. And it's going to sit there until this true up calculation is done. And then they say, okay, it turns out one of you owed the other. That's released from escrow. And then, each party receives whatever was left in escrow, or their escrow plus what they received during the true up calculation. So yeah, that's kind of the process. I wanted to walk through that with you. If you have questions about that, please feel free to reach out, leave us a comment. You can reach out to us at support@ProjectionHub.com. Our role in this, we're helping clients create financial projections, often for SBA loans, for acquisitions. And so we are doing a little bit of work on the net working capital, but it's at a pretty high level. We're not getting into the weeds and saying, let's look at the individual invoices or how much each account is going to be. That's really going to be your CPA and probably your lawyer's job to really get into those details. We're really helping at a high level, roughly what should working capital be, make sure that you're going to have sufficient working capital to operate the business going forward and be able to present that to your SBA lender, for example. So that's our role. If you need help with financial projections in your acquisition process, please let me know. You can reach out to us again at support@ProjectionHub.com. All right, thanks.